Hello everybody, this is Jose Blasco here. We are 10 seconds before we start. It'd be great if you could just type on the comments box, type a quick hello, a quick good morning, or yes, Jose, we hear you. And that would indicate for me the fact that you hear my voice as well as seeing my screen, and therefore we'll be ready to start. So please go ahead and let me know if that's the case with a quick little message on the comments box, guys, while I'm maximizing the beginning slide for us to begin the session. Wonderful. Thank you for that. Thank you very much for that, guys. So let's begin. Today is 7th of April 2019. We are getting together for sharpening purposes today. Like, the idea is to take what we know and keep taking it to the next level, okay? Growing when it comes to understanding more in depth certain market principles, growing in the sense of putting certain rules together that add more precision on how we trade, growing in the sense of understanding more the intricacies when it comes to adjusting the AutoUFOs app and make it compatible with a trading methodology, etc., etc. And I mean, sharpening means many things. Okay, so welcome to the session, my friends. My name is Jose Blasco. Not sure I've said it. I'll be your guide today. And before we begin, as always, a quick reading of the disclaimer. Let's go for it. The following videos, clips, and demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through the demonstration do not indicate in any way the results you may receive on using our products. Okay? Good. So we are now ready to start. I have TradingView ready. I am also loading TradeStation. Today we're going to be using two platforms depending on what is it that we're going to be doing. We may go switch back and forth between platforms because like everything in life, everything got pros and cons, and TradeStation is amazing and has amazing pros, but also some cons, and TradingView is also amazing and has many amazing pros, but also some cons. So we'll be switching back and forth between platforms. That way as well, you get to see different things done differently as well, and depending on how you trade yourself, depending on the brokers that you use, etc., etc. So hopefully this session, thanks to using two versions of the app, this session will also be a little richer for you guys when it comes to understanding how to do what you need to do. Okay, very good. I'm just reading the comments box, which up to this point it's hellos and good morning. So wonderful, guys. Good. So let's begin today. Today it's an exciting day, guys. Okay, because if you think about all the sharpening sessions we have been doing for 7 weeks, all of them have been around the concept of options trading. We've been discussing debit spreads, credit spreads, directional trading, non-directional, many things that are extremely powerful. And by the way, let me tell you that we'll need to come back to all of these and go way deeper than what we did in those 7 sessions. There is much more to come when it comes to options trading. But we also agreed to have a little bit of a pause when it comes to options trading, because one of the most powerful applications for options trading is when you trade, not necessarily for intraday trading purposes. I'm not saying you could not use options for intraday. Of course you could. But most traders, normally they would look at options like a vehicle for you to be in a trade that may last multiple days, multiple weeks, multiple months. So somehow those 7 weeks hopefully have been very enriching for you guys, but at the same time, we have left a little bit on the side the short-term traders, okay, where most short-term traders, they normally use other instruments, such as especially Forex and futures, as the key instruments to produce that short-term income, that intraday trading income. So the idea is that during today and probably maybe 1 or 2 more Sundays, we'll see how fast we progress through content. But the idea is to spend a few weekends now, a few Sundays, doing sharpening in a way where I was going to say we forget about options. I mean, you never want to forget about options, but we kind of put options on the side and we focus much more in depth on futures and forex and look at lower time frames in order to be able to execute trades which are quicker, which are less long lasting, and therefore we may need to add a little bit of extra rules to gain a little bit more precision, because of course if you plan to catch a move which is $20 and you got in a little too soon or a little too late, it's kind of okay because the move is still $20. But if you're planning to catch a move which is 20 cents because it's an intraday move, well, for sure you have to be precise, right? And precision is always welcome, by the way, because if you are precise, you get stopped out less often too. So, the other good news about the sessions that we are about to begin is that what you will learn to apply in this session with the AutoUFOs and the different timeframes and the forex and the futures. So what's going to happen is that all of these will be directly applicable as well to the longer timeframes as well. You will be able to use many of the concepts that we're going to cover in the intraday that will then be applicable for the longer term as well. Okay, so again, lots of good stuff, lots of fun, lots of growth to come, etc., etc. Okay, so. I'm just loading here on my TradeStation the UFOs and so on, just to be ready. But the way I would like to begin, guys, it's as we have done before, with a white blank page, okay, ready to start typing notes here. And again, remember, when we do sharpening, a little bit of the concept that I use on how I deliver the information to you guys, it's kind of like a conversation, like I remember I said that once, I believe, is like if my nephew was to ask me, hey uncle, teach me how to trade, probably what I would do is grab a piece of paper and a pen and my laptop and sit in front of my laptop and that piece of paper next to my nephew and start making notes and start going over content in a way that is in one hand a little improvised, but in the other hand not improvised at all, with a very, very clear purpose, okay, and making those very dynamic notes as we are going through content. So I'm gonna kind of do the same. I particularly enjoy very much, and I believe based on some of the comments that we receive via emails, it seems that it's working well for some of you as well to conduct the training in this fashion. So hopefully that's the case, and if it's not the case, you guys let me know. Okay, yeah, Pavnit, if your screen is blurred, is because you're probably the resolution you have set up on your YouTube is low resolution. So if you move your mouse to the bottom part of YouTube, you will have a little wheel, which is the settings wheel. If you click on that wheel, select the option HD, which is high definition, and you're gonna be able to see those sessions. I am streaming at full HD 1080, so you can watch the session at that resolution. Okay. Good. So again, that's the plan. Okay, so let me make a few notes in this beginning part of the day on certain things that I would like to address. Okay, so one thing I would like to address with you guys is, I kind of said it before, to add more precision to the trades. So this is something that we need to talk about, how by putting a methodology in place for intraday trading, we're gonna be able to add more precision. More evidence, okay? So how, when it comes to taking an intraday trade, how can I add a little extra more evidence when I'm planning my trades? So instead of relying on something that is already good by itself, but just add a little more evidence to make that good thing even better, because now you add probabilities the more evidence you have, right? So how can we do things like that? We also need to talk about being more conservative, okay? So in some of the emails that we have received from some of you have said to us, and we're taking that with 100% respect and very open-minded. Some of you have said to us that sometimes the trade that we plan are just a little too quick, a little too aggressive, a little too fast, right? And I mean, let's face it, when it comes to trading intraday, being over relaxed, taking a nap on the sofa in order for you to take a trade, it's kind of a little bit of a utopia, if you don't mind me to phrase it this way, because it's intraday trading. So by definition, it's gonna be quick. Is that making sense? But at the same time, within the definition of quick, right? So there may be different possibilities on how to enter, like, using a war analogy, you are the guy carrying the flag, right? And you are running in front of everybody. So, and by the way, if you got a good, a good team of soldiers behind you, it may not be crazy at all. But at the same time, some of you, just because of your personality, and this is something to keep in mind, some of you may be thinking like, hey, wait a minute. Not only I want more precision, not only I want more evidence, I am a very conservative guy. I am super crazy perfectionist, and I want to enter in a way that is the safest as possible. And again, safest is a kind of a funny word in trading, because there is no safe, there is no risky. It's all about how you manage your risk and your reward. But somehow, by using just English words not related to trading, if we use the word safe in context outside of trading, so that's kind of like the definition I'm using now, right? So it's just to find yourself in a situation where you are just a little more conservative on how to enter the trade. So I want to give you choices for that as well, because some of you, based on your personality, you may need that. And trading, as probably we all know, and if you don't know yet, you will, trading is a psychological game, big time, in the sense that you may have this amazing knowledge on how to trade, but if you don't make your trading methodology compatible with your mindset, you may get emotional when it comes to taking trading decisions, and therefore you end up getting in trouble. And it's not because your methodology is not good, it's because the way you apply it carries a series of mistakes because you got a series of emotional decisions. And everything comes back because, some of the rules in your methodology, you should not use those because, that was the methodology maybe of another person who had a different psychology, who was okay being a little more aggressive, but maybe it's not you, or maybe it's you. So, I want to give you choices. So you would go ahead and look at yourself in the mirror and acknowledge who you are, what type of trader or person you are when it comes to being more conservative or less conservative. And then you would want to put rules around that match your personality to have an easy time executing your methodology. Okay, guys? And that's what that's what I mean here when I say more conservative. Okay, which is, again, is a word that could be interpreted in very different manners depending on different people. So that's why I gave you a little bit of a long explanation here to make sure that the expectation of what that means to me in this sense, or what that will mean during the sessions that we do together, it's based on the context that I just explained. Okay. What else? I also want to talk about something super important, which is setting targets. Okay, this is something that we need to discuss more in depth. Most of the times we discuss the rationale when it comes to entering a trade, and we talk about the entry. And of course, it doesn't make sense to talk about the exits unless you have an entry. But one thing that you will realize, if you haven't yet, is that in trading, of course, a good entry is very, very important. But once you got into the market and the market is moving your way, what's really, really important, and many times even more than the entry, is the exits, meaning when do you take profits. Imagine that a market is going to give you a 50-point move, but you only collected 5 points. You may say, okay, yeah, I'm profitable, but guess what? You left so much money on the table. And it's not about being greedy either. It's about what if the next trade is a losing trade? And what if the trade after that trade is another losing trade? So if you could make your profits of a greater size, that would allow you to absorb losses that come later in time, which, of course, it's all about probabilities. If you have good entries, the losses are going to be less probable, but at the same time, even if you had a methodology that gives you 90% win-loss ratios, you still have the chance of losing by 10%, which means that you could certainly have 3 losses in a row, because every time you trade, you got 10% of losing. And of course, the higher the probability, the less often you are likely to lose, but at the same time, you could still take 2, 3, 5 losses in a row. And if the times where you made profits, you had maximized the size of the profit, well, that would really, really alleviate the cases when you have to assume a loss, which is part of the game, and we are happy with it. But in the end, when those losses happen like 2, 3, 4 in a row, then it stops being fun, isn't it? So, talking about the exits in that case is going to be an important conversation to have, for sure, when we get together in the trading sessions, especially on the Tuesdays when we do the trading. I always write it in the chart, on the chart, and normally, unless I forget, I even give you time to take a screenshot, and you have the entry, the stop, the safety target, the final target, all those things. We do talk about targets, but I would like to get deeper into setting targets and be just a little more advanced, okay? Just a little more advanced. on how to do this a little more efficiently. Okay. So we'll talk about that. Another thing that I want to talk about in these sessions, and I guess that you understand why this is going to take a few Sundays. Okay, we have a lot of things to discuss, but another thing that we need to discuss is trade management. Okay, so you may have heard me say, and it's absolutely correct, that doing nothing is always the right thing to do. Right? So if you plan to enter at certain price and you plan for your target to be a different price and you plan to stop yourself out at another price, and those three are the three variables of your plan: entry, the take profit, and the protective stop, and you just set that, you predefine that, you pre-plan that, and then you just execute that, and therefore you do nothing, you just do that. Okay, and when I say do nothing is because normally when you execute, you don't do it manually. Okay, you use the technology, you place those beautiful bracket orders with your platforms, isn't it? No matter if you're using MT4 or you're using TradeStation or IB or TOS, normally you set a bracket, right? And you have the entry, the take profit, and the protective stop. And basically the computer executes the trades for you, even if your computer is off, isn't it? So one action when it comes to trade management is to do nothing. Just let the computer do what you pre-plan ahead of time. Okay, and if you were to do that, it's fine. There's nothing wrong with that. But at the same time, again, there may be room for improvement. And I'm not saying to improvise. Okay, I'm talking about rules. There may be room for improvement when it comes to how to manage the trade by adding a collection of rules that in certain conditions, in certain situations, you end up doing certain things that may involve changing a target, moving your stop, closing the trade ahead of time, things like that. And again, the key would be the timing of those actions. Just like the timing of the entry and the exit is key, the timing for the trade management is also key. I mean, we know that. I'm not saying anything new here. Our job as traders is to be masters of the timing. The more masters we are, the better we end up, right? So I would like to get deeper into that, okay, and have proper conversations about things that you could be doing to manage your trade more efficiently, and therefore to minimize the times when you lose, to maximize the times when you profit, and also to maximize the size of your profits and minimize the sizes of your losses. Okay, all of this is the ultimate goal, and we're gonna hit that objective by by going into it from different angles, which is what I'm writing on the screen at the moment. Okay, another thing that we need to talk about, okay, which that's going to be very, very specific to futures, okay, it's the right symbols to be used, okay, and that's very important because there are a few theories out there when it comes to which symbols to use, and I would like to give you different angles. Again, it's all about probabilities, okay? So there is no absolute in trading. It's all about probabilities. So every decision that we take in trading will have pros and cons. But I would like to put on the table a few combinations of symbols that potentially will make a difference. And I would like to explain it to you guys so you understand this better, especially because also different trading platforms may use symbols differently, okay? And we do need to talk about that. Again, looking for more precision, etc., etc. Okay, so we'll talk about that, and you'll see exactly what I mean. Long story short, for the ones of you here that never traded futures before, the only thing you need to know at this point is that when you trade futures, what you trade is an instrument which is called a contract. And like all contracts, there is an ending date. There is an expiration date for the contract, which means that, for example, if you trade the S&P and you are trading the June expiration, when that contract expires, then you would find yourself trading the September expiration, which is the expiration after June. Okay, and every one of those contracts will have different symbols. It's not like when you trade stocks where you input MSFT for Microsoft and it's like that forever. It never changes. Why? Because stocks don't expire. Well, futures do, and therefore there is symbology attached to it, and there are a few things that are key that not everybody understands in a proper way, and there are extra advantages to be acquired by using the symbols correctly. Okay, so I'll talk about that as well. Forex. When it comes to Forex, there is another thing that we need to discuss, which is the fact that Forex is non-centralized. Okay, and this has advantages and disadvantages, like everything in life again. Okay, everything like got pros and cons. The beauty of Forex being non-centralized is that next thing you know, you are trading the biggest market in the planet, because you are not limited to a city or one exchange. It's the biggest exchange in the planet. Sorry, it's the biggest market in the planet, not exchange. Sorry, it's non-centralized. So, but when I say it's the biggest, I mean it's the biggest by far, the largest. It doesn't even compare to anything else. That's how big Forex is, right? So there is some data out there that if you Google it on the internet, you'll find things like, $5 to $6 trillion traded per day in Forex. Okay, well, futures markets, it's just like a little tiny thing compared to Forex. And I'm not saying futures is not relevant. It's such a relevant asset. I mean, futures is like 3 to 4 times the size of the stock market. So imagine, right? Wall Street, New York, which has the reputation of being one of the biggest markets in the world, where futures is like 3 times the size. So futures is huge, but what about Forex? Well, now because you have no exchanges, you are dealing with all the currencies available in the whole planet Earth, and obviously it's the biggest. Okay, so it's a very powerful market for you to understand and trade, but then it's tricky because it's not centralized. So when you get information on your chart, well, it may not be fully 100% accurate, or it may vary a little depending on the broker you use and stuff. And therefore, when trading Forex, for intraday trading especially, you gotta be a little careful. There are a few things that you need to know, and if you don't pay attention, you may get a stop out, or you may miss a target, and then you wonder why. Okay, and we need to talk about that because again, like everything, if used properly, actually it may give you a little edge, because some people out there may not know what we will be discussing when we talk about Forex, and therefore those guys, they put themselves in a losing position, where if you know what you're doing, then you could be in an advantageous position compared to many of those traders that are more, let's call it non-professional, if you wish, versus the traders that we are more prepared, and we are in the professional side. Okay, so again, like, very, very big picture, for you to understand certain things that I want to discuss. And now I'm going to use capital letters, even though it's kind of rude, but this in the end is going to be the key, the rules. Meaning that the ultimate goal as we conclude those sharpening sessions is that all of you guys, and I said all of you, end up with specific plans, with specific rules that make you mechanical, that make you objective, non-subjective. And therefore, it's all now left to how disciplined you're going to be to follow the rules, and how are you going to manage your emotions to be a proper professional trader. Because the idea is to get everything under control. Okay, I cannot control you guys, because obviously we're individuals, we are independent, and most of us, I guess, we are adult. So, I have no intention to control anyone, but at the same time, it's key that you control your mindset, your emotions, your psychology, and certainly keyword, because it would not make sense if I use the word rule and I don't use the word I'm about to use now, which is the word discipline. So what's the point of having rules if you're not going to be disciplined? Does that make sense? So it would be a waste of time. So the idea is that we end up with very solid plans, with very, very specific rules. So you know exactly how to execute. And therefore, in the end, it's all down to your level of discipline and how professional you're gonna act, and how you're gonna manage your emotions. Okay, which of course we can also do sessions on mindset, and I can share with you exercises and stuff that can make you better from the mindset point of view. Okay, but it's kind of like the problem of the egg and the chicken. If you have the rules and you don't manage your mindset, you get in trouble. But if you have the mindset but you don't have the rules, then you are basically gambling in the marketplace. So what goes first? Okay, well, since for you to practice, you need something to practice with. So let's begin with rules, okay? And then in the future, we can certainly also conduct sessions to talk about the mindset of a trader, and discuss certain things, and also discuss certain exercises that you may want to do every time you trade, or after you trade, or before you trade, things that could really help you to also master yourself and your mindset, your psychology, apart from your rules. Okay, guys? But now, if you notice, one thing that is critical out of everything I said is that to be able to do everything I said here, and by the way, I have more stuff in my mind that I want to share with you, and this is just like a big picture, description of some of the things we're gonna do. We're gonna dive deep into many of those things, very, very deep into others, okay? And I will even probably add even more. But in the end, bottom line, if we don't work as a team to do this, then these sessions will simply be interesting, and in the end, not much will happen. So what I would like to ask you, and this is a very, very direct question, okay, guys? What I would like to ask from all of you, and please, I need everybody to answer on the comments box right now, okay? And this is, again, a very direct question. What I need from you guys is that you are ready and open to work as a team, right? There will be times where I ask questions, I need answers. There will be time where you have questions, I'll give you answers. There will be time where it will be time for me to keep you accountable, and you have to be diligent. So we need to work together as a team, because if not, then those sessions are gonna be interesting, but then, you know, not much will happen, okay? And by the way, I would respect if some of you in the group are just, you know, joining us to see how interesting it's gonna be, but that is not my mindset, okay? My mindset is really that, you know, we are not just spending time here on Sundays just to spend time because we got nothing better to do. My plan is to really create an impact, okay, guys? Now I cannot do it without you, so that's why I'm asking you to work as a team, okay? Can I count on you all, guys? Is that okay? You guys need to be a little more convincing than that on the comments box. I'll be reading some of your messages in the meantime. Jihad, being a pilot, I love checklists. This is going to be trading checklist I've been looking for. Exactly. Love it, love it, love it. Thank you, guys. You guys are making my day. And again, not only I'm very happy to see your response on the comments box. Again, I cannot do it without you, okay? This is, again, purely teamwork, okay? So let's work on this, okay? Wonderful. Perfect, guys. Good. So let's begin, okay? And again, let's go back to an explanation that some of you may have heard before, but I want to rephrase it just so we have like, you know, the same starting point for everybody in this session, and the following sessions is going to be the same starting point. And the explanation I want to go over is when on Tuesday sessions, I am using this workspace on TradeStation, where in the bottom part of the screen, I have a chart with an average. And on the top part of the screen, I have a chart with the AutoUFOs, okay? So what am I looking for when I'm doing that in those Tuesday sessions, right? And why am I doing that? Because the idea is to use this methodology, okay? And take it to the next level, adding, as we said, adding more precision, adding more evidence, you know, all those things that we said. But we're gonna start from that starting point, and therefore I would like everybody, okay, everybody, to have it fresh on their mind on what is it that we do on those Tuesdays, okay? Then, you know, I'm gonna provide you information in a way that is modular, and modular enough where you can change the sequence of certain of the sections. Like, for example, in this methodology, I'm using a moving average on the UFOs, and then I'm going to add a bunch of rules for more precision and more evidence, all those things. Great. Well, guess what? Once we cover those other things to have more precision, more evidence, blah, 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 then what you could do is take that with your current methodology that may not be a methodology that uses 2 time frames, that may not be a methodology that uses a moving average, you know. So in other words, I'm gonna give you information in ways that are modular. So then, you know, maybe you have already some sort of a solid trading methodology and you just want to get just a little better. So maybe some of the components I will be teaching, you will be able to plug them into your methodology, and therefore what I'm about to explain now, which is the methodology from the Tuesdays, you will not need that. Okay, but at the same time, some of you here may not have a methodology at all. Maybe some of you never traded futures or Forex. Maybe some of you only traded long-term, never short-term. Maybe some of you never traded period. Okay, so again, I would like to provide tools for everybody, and in order for me to, you know, enrich everybody and give you you know, a better approach to your growth, I think that, you know, I'm gonna make everything modular, so that way, you know, everything could be combined. Okay, that's the idea. Okay. So again, back to what we do on Tuesdays. Okay, so on Tuesdays, okay, we have 2 charts. The bottom chart in this case is a 15-minute time frame. Okay, and it doesn't need to be 15 minutes. Okay, but for now, bear with me on those parameters, because later, again, I will add the rules. Okay, so I'm using a 15-minute time frame, and what I needed to know about the 15-minute in this case is not that it's the 15 minutes. What is important about the 15-minute time frame is that it's a common time frames that everybody uses, that every trading platform in the world has available, right? The 15-minute time frame is very common, okay? I would say never seen a trading platform that does not have the 15-minute time frames. That's why this is important. So because the time frame is a time frame that is being watched by many people, and when I say people, I don't only mean humans, I also mean computers, right? They're programmed by people, so somehow there are people behind them, but in this case, obviously, they are not people, they are computers. And the idea is to plot a moving average on that time frame, and I'm using a standard one with TradeStation. When you add the moving average exponential, by default it comes with 9 as a setting, so that's the one I have. I have the 9 exponential moving average, okay? It's an EMA, exponential moving average, and it uses 9 periods, okay? Is 9 magic? No, it's not magic. And many other moving averages probably would work just as well. But the idea is just to do things that are as standard as possible. So I'm using a standard time frame with a standard moving average. And why am I doing that in this methodology? Well, because I would like to see what many people sees. Because if I was to focus on what many people sees, I may, okay, and notice I said may, this obviously is not gonna be a guarantee. So what I mean by that is that it's gonna be a matter of probabilities, and you will see how I stack odds in my favor in a minute. So by doing that, what I may end up seeing is what is the price at which those computers start buying or selling? What is the price at which some fund managers may start adding money into their portfolios? Why? Because it's a very common time frame, it's a very common moving average. So I'm using a tool that many people uses. Okay. Now, in one hand, when you trade, you don't necessarily want to do what everybody does. But it depends who everybody is. Okay. For example, what you don't want to do in trading is knock the door next door, right? So you go talk to your neighbor and you say, hey, hi neighbor, what are you doing today? And he says, well, today I bought 200 shares of Microsoft. So what do you do now? You run back home and you buy 200 shares of Microsoft, you too. Well, that would not be a good idea. Why? Because your neighbor is not a professional trader. Your neighbor is not a hedge fund manager, so you should not buy stocks when your neighbor buys stocks. Does that make sense? You don't want to do what the majority of uneducated investors do. But what I'm doing on this chart, the 15-minute and the moving average, that does not represent the neighbor. That represents, again, computers. Many computers around the world are buying and selling out of those mathematical calculations, which are moving averages. We'll talk about Fibonacci's too, and other ratios. Other key points in the day, the prior day low, the prior day high. The Globex high, the Globex low. There are multiple things out there that we will discuss. Okay. Right now we are just focusing on a moving average, which is one of them. So that particular tool, it's telling you a price point where you may have one of those professional participants enter the market at that price. So that's nice to know. Okay, that's nice to know. Now, still, even though that's nice to know, that does not qualify as a valid trade. You are not going to buy at 28.95 just because the average is that price. Sometimes you would profit if you do that. Okay. Sometimes you would profit if you do that, but sometimes you would not. And if you would not, then the next question to be asked is, okay, well, did you really have a great probability doing so? Okay, was it a very good idea to just buy just because of the moving average, or do you need more evidence? Do you need more tools? What about if you buy and it goes your way? When should you take profits? What about if you buy and it goes against you? When should you take your loss? Well, again, there are more things that are needed to plan a trade. But again, the starting point of the methodology is to look at that moving average in a classical time frame, such as 15 minutes at this time, because again, that may represent, and I said may again, that may represent a price point where you got those professional traders entering the markets, manually with computers or both. Okay, but the problem in trading too is that people may change their mind, right? So let's say, for example, those professional traders are looking at the chart and they have this 28.95 in front of them, and they're like, that's it. That's a good average price. If the market comes there, I'm going to buy. But, 2 minutes later, there is a terrible news on TV, and now the whole mindset, the whole sentiment is, oh my God, the world is ending, right? So probably that professional trader that was planning to buy at an average price totally changed the mind, totally changed his mind, and now that person, that computer doesn't want to buy anymore. Why? Because there is a change of conditions, if you wish, and that possibility is no longer a possibility, and that's why I said earlier may, because they may buy, they may not buy, they may change their mind, right? So if you were to use the moving average just by itself, it's not high probability enough. That's what I'm trying to say, but it could certainly be a help, because if may end up being a reality, then that means that you would have more buying after you buy, or you would have more selling after you sell, and obviously that's how you profit. Actually, that's the only way to profit in trading. You need more people buying after you bought, or more people selling after you bought, selling after you sold. In other words, you need tools that act as a catalyst, as a magnet, an attractive tool that may add participants to buy after you bought or sell after you sold. Okay, so this is something important for you to keep in mind. Okay, so that's why the starting point in this methodology that we do on Tuesdays is to look at the moving average, even though somehow the moving average is the least important of the tools from a probability standpoint, but it's where we start because it may have some importance, and most importantly, as you will see as I put the rules in place, it will also help us to be mechanical and have a very simple, clear decision on whether to be a buyer or whether to be a seller. Okay, so you don't end up on the wrong side of the market too often. Okay, most of the times you are trading long when it's time to go long, you're trading short when it's time to go short. Okay, but now, everybody with me on what I just said? I mean, I took my time to explain something that I'm sure for some of you is quite obvious. But again, I'm trying to create a very, very strong foundation for everybody here. So I'm taking my time. I'm not rushing into this. How is it going so far, guys? Yeah, so I'm just looking at the comments box there. Yes, Mario, to insert the average is very simple. You will just come in here and you would just right click. Okay, you will right click and you would go for insert analysis technique, right? And the moment you reach insert analysis technique, okay, you would find the tab on the left indicator, then you go for the M, and here is gonna be your moving average exponential. Okay, that's it. So then you click OK. Okay, and if you have the prompt for format check marked, the moment you click OK, you will have a window that is asking you for the inputs, and notice how by default it comes with 9. So you just leave it as 9. And then optionally, if you want to make it cuter, you just go for color and you change the color, or you go for style, you change the weight. Okay, in my case, I made it purple. Again, that's gonna be your, depending on your taste. Okay, but anyway, so now I said all of these things about the moving average because, as I said, it's gonna be relevant. Okay, but let me pause and rewind all the way. Okay, and I'm even tempted to let me do this. The homepage of our website. So I'm pretty sure that most of you probably have read this paragraph at the beginning part of our website. Maybe it's healthy if we read it together too, because really that paragraph, every word has so much meaning. So, I mean, one portion of the paragraph that I would like to highlight at this moment in time is that it says that the reason why the orders may be there in the first place can be really diverse. Okay, so what orders? Well, we are looking for those on-field orders, isn't it? So on-field orders means orders that are in the market waiting to get filled and they have not been filled yet. So those orders can be there for very diverse reason, but no orders, no movement, right? So think about very extreme events. Like, for example, I think it was 7 or 8 years ago now when we had in Japan this crazy event with a tsunami, with the I mean, I don't even have words to explain what happened there. It was just completely crazy. The leak from the nuclear energy, from the nuclear plant, the tsunami, the water getting into the coast, thousands of people dying. The event was terrible. And therefore, out of the event, many people may decide to buy or sell out of the event. So those on-field orders may be added to the market because of an event or anything else. And certainly, the moment those orders change their stage from on-field to being filled, that's when the market moves. I believe we all know that. And if you didn't know that, probably you have read the website and therefore you knew that, right? But it's an important fact because there is something that people tend to forget. Happens all the time, probably because, turn on the TV and the only thing they talk about is about news. So many people have this tendency to explain price movement out of news or whatever, which, indirectly, certainly could be a factor. Like, for example, the tsunami in Japan was responsible for the market to move. True. Why? Because someone big or many people added many orders in the market and therefore the market moved. Why? Because they added the orders out of the tsunami event. So the tsunami event is indirectly responsible. What's responsible for the move is the orders, but the orders are there because of the event. So indirectly, the event is responsible for the move, where the direct force that pushes prices is the orders. And this is something that it's even clearer if you think about it from the point of view of what if the tsunami in Japan took place over a weekend? Well, if the tsunami of Japan took place over the weekend and the market is closed, then the market would have not moved even though the tsunami is happening. So what moves price is the orders getting filled. Okay, of course, then on Monday, they will add orders or cancel orders, and all of these will produce the move, but the move will be produced as the orders get filled on Monday, right? So you have to differentiate between two things, which is the direct force that pushes prices and the indirect reasons why orders enter a market. Those are two different things. And one of the purposes that I put in a written form earlier was to add more precision to how we trade. And therefore, to add more precision, we need to be laser focused on the on-field orders because that's the direct force that pushes price. Is that making sense? So that's why earlier I said the moving average is great, but it's not enough. We also have the AutoUFOs on the upper chart because the AutoUFOs are precisely that. I mean, the name says it all, UFOs, on-field orders. So the app is identifying in the marketplace where the on-field orders could be. And here's something that is quite interesting here. In the marketplace, when on-field orders are added to the market, for sure, those on-field orders could be canceled. I said it before. Let's say an institution wants to buy a stock, but then there is a major news, which remember, news are indirect motivators for orders to be added or orders to be canceled. So let's say, for example, there is a conflict with a US and China trade deal, for example, and some hedge fund manager that was very happy to buy a certain stock at a certain price just changed his mind or her mind and now cancel the orders. Well, then we have a problem because the AutoUFOs tool on the bottom part of the chart has identified on-field orders located at 28.94.25, but then if those are canceled, well, then you get in trouble because obviously there is nothing to stop price from falling. Is that making sense? And that's why 71% of the times in this particular case with this time frame, the AutoUFOs work, but that's why you also have in this case 30% or 30+% of trades that will not work. Why? Because there will be times that either orders will be canceled or new sell orders enter the market that are of a greater size compared to the buy orders that were in the market waiting to get filled, right? So that's why what's going to be very powerful is to combine the AutoUFOs with, let's say, for example, a moving average. Why? Because if you think about the two almost opposite concepts I just described, which is the moving average and the AutoUFOs, think about it. When I was explaining the moving average, I kept using the word may, right? They may buy, they may sell because of the average. Okay. In other words, the moving average may add new on-field orders that are not in the market yet. That's why the moving average may do, where the AutoUFOs above is showing you already where the on-field orders are. So could they be canceled? Yes, right? I mean, not too often. At that moment in time, it's showing 71%. So like 30% of the times they would be canceled. In that particular case, it depends on the time frames on the markets, as most of you will know. It could be 60, it could be 55, it could be 72. It depends on the markets and the time frame, but they could certainly be canceled. But if you were to combine the AutoUFOs that already gives you an edge together like with the moving average, now you have on-field orders in the market waiting to get filled already, which you know is the direct force that pushes prices, together with a moving average that represents the possibility, that's why I said may, the possibility that new orders may be added on top of the on-field orders that are already present in the marketplace. So when you put the two things together, I guess that we all understand, we all agree, but I would guess that we all agree here, no, because I would say it's common sense. So we should all agree, I would say. And what we agree on is the fact that those on-field orders, that combination of on-field orders above and moving average below, it's basically increasing your odds. So this is one of the reasons why I use two charts on that workspace, and on Tuesdays I have this moving average in a classical time frame that many people see, including computers, because that may represent new orders to be added to the orders that are already present in the market. But at the same time, that was not enough from a point of view of probability. The AutoUFOs are going to add way more probability and help way more because the on-field orders are already in the market. But when you combine the two, now you have an even better enhancement. Okay. And by the way, I mean, sometimes we have questions from some of you where you ask, do I need to use the moving averages? Could I just use the UFOs on their own? And the answer is, of course, yes. Of course, yes. You could certainly use the UFOs by themselves, and that's it. And you buy when it's green, you sell when it's red, in a context of a certain time frames, with a context of certain rules for when to take profits, when to stop yourself out, and you may have a methodology that uses nothing but the AutoUFOs. Okay, but at the same time, normally what would happen in most cases, if I zoom out, is that there are too many AutoUFOs. There are too many zones, okay? And that's good, because that gives you many trades to be taken, okay? But we are not computers, we are human. And, if I give you, 55 trades per day, probably you cannot take them all. So the beauty of using a tool to be combined with AutoUFOs is that you reduce the amount of trades you're going to take, and you reduce it in a way where you focus on the trades that are likely to be of a higher probability. Instead of trades that are going to be okay, you go for the trades that are going to be very nice. Is that making sense? And that's one of the reasons why we are combining the moving average with the AutoUFOs. Okay. One more point here when it comes to the on-field orders is for all of you. And again, right now I'm touching on these concepts from a quite generic point of view, but again, it's very important that we have a strong foundation. So when I explain the rules and I explain why, everybody understands the rationale behind it. Okay, so this is probably, especially for the ones of you that are more advanced, this is probably the kind of like the most, the least fun part of these sessions. Okay, but it's important again that you listen carefully. So please stay with me. Don't be distracted. Maybe on your phone, stuff like that. I know some of you are smiling now. I caught you, right? But stay with me, because this is important stuff. Okay, guys, we need to speak the same language, because there are many rules. Okay, you will ask, so why do you do this? Well, it's because we talked about certain things, and you need to pay attention. Okay, this is important, guys. Remember, teamwork. Okay, so now coming back to the AutoUFOs and the concept of on-field orders. The on-field orders that, like, if, for example, if you see this beautiful green UFO here, this beautiful green flying saucer, right? If I was to hide everything on the chart, right, and the only thing I show, okay, is the green circle. Okay, let me be a little more precise, but just moving it down like that. Okay, so if the only thing I show you on the chart is the green circle, the green UFO, okay, and this is green represents buy orders, right? So this is where you have the buy on field orders. In other words, this is the best place where to buy, and obviously the best place where to buy, I mean, you want to buy low and sell high, correct? So this is the lowest part on my chart. If I hide everything else and I only look at the UFO, right? So what does that tell you? Well, it tells you that this zone, okay, that, this zone right there, somewhere there, which is the candles on the bottom part of this move, which are lining up with the green UFO. This zone is precisely where the on-field orders were left behind. But that's not what I want you to realize, because you know that. I mean, you just need to look right, and you know that. Even if I didn't explain that, you know it because it's written for you. And you also know, probably because you have read the manual and because you attended multiple sessions with us, that the circle within the circle represents where the greatest concentration of on-field order is. So you know all of that stuff, okay? But what I want to talk about now, it's a little beyond, is look at what happened when price left this very bottom part of the candle and went up. Price traveled all the way there. That's how far price was able to travel. And in other words, think about the energy, think about the impact that was given to the market. Think about how hard they kicked the market to move the market from that bottom all the way to the top. I mean, who has the energy, the power, the buying power, the account size capable of producing such a move? Well, obviously, it's not a retail investor. It's not our neighbors. It's not a friend that we met in the gym. It's probably one of those hedge fund managers, institutional player, some computer with massive amount of buying power behind to be able to produce that. Is that making sense? So what am I trying to say here? Well, I'm trying to say that if you were to think about instead of where to buy or where to sell, you were to think about who is buying, okay? Probably this guy is a big guy, okay? And what happens in trading, and that's why we got a 71% probability in this case, which again is not always like that, could be 60, could be 55 or whatever. But why is it that we have a great probability? Well, it's precisely because of the who. Who is buying in that green circle, okay? Well, it's a big player. And what happens if you compare the big player compared to, let's say, our neighbor again, nothing against our neighbors, okay? But let's say you compare the mindset of your neighbor compared to the mindset of a hedge fund manager. Well, you guys tell me, and this is just common sense again, who has a mindset which is more stable? Who has a mindset which is more business oriented? Your neighbor? Or one of those top hedge fund managers in the world, right? So in other words, who is more likely to change their mind when it comes to buying or selling a stock or futures or Forex or whatever? Well, your neighbor is more likely to be subject to decide, okay, I want to buy now. Oh no, I changed my mind now. It's more volatile. It's less robust as a decision-making process, where normally the biggest players in the market, when they want to buy, and they don't stop buying until they buy everything they wanted to buy because they have a reason why they want to buy at that price, right? And could they change their mind? Of course they could change their mind. But normally they don't change their mind as often as an uneducated investor, a person who is not a hedge fund manager, a person who is not professional. Okay, that's why those on-field orders that we identify in places on the chart, they give us very, very nice readings when it comes to performance, because it's not only about where the on-field orders are, is also about who they belong to, right? And now what are we doing on Tuesdays? Where we are looking at where are the on-field orders that belong to the biggest guys, and we buy when they buy while their computers are about to buy too, by using those automated mathematical calculations such as moving averages. So if you understand everything I said using words, and you think about what I said, and you think in terms of rational, well, obviously this has to stack odds in your favor. Am I saying this is going to be a risk-free methodology, you're never going to lose? Of course not. Of course not. Things happen. Even a big player may lose because a bigger player trades against that other big player, and you have a fight between Goldman Sachs and JP Morgan, and if you were buying in the wrong side and you were with the wrong institution, guess what? You lost that day. Is that making sense? An uptrend may change and become downtrend. If you were caught in the middle of that, you get a loss that day. But again, this is when then, we'll talk about that, when risk management comes into place, where those times when you lost, you keep it small, and the times when you profit, you keep it greater, and then your accounts grows. But again, right now, I'm just talking about, I'm just caressing the concept of more precision. and giving you a little bit more insight into the rationale of why we do certain things with the way we do. Because what I don't want you to do, guys, and it's not about me giving instructions in the form of order. Okay, again, we are all adult here. Everybody can do anything they want, that's for sure. But I want you to understand why I propose certain rules the way I propose them, so you could assess based on your own rationale and logic if it makes sense to you. Because if it does make sense to you, what will happen is that you will have an easier time to execute with confidence. And if you have an easier time to execute with confidence, this will transform into an easier management of your emotions, and therefore you will be less prone to make mistakes out of getting emotional. Why? Because you understand what you're doing. Okay, so that's why I'm spending a lot of time here with quite detailed information about things that it's quite simple, to be honest. And some of you, I would guess a bunch of you, are not listening to this for the first time in your life, but at the same time, it's very important that you understand the rationale, okay? So again, we are looking to buy where the unfilled orders are. We want the unfilled orders to belong to big players, but we want not only we want to buy when they buy, we also want to buy when they buy with the unfilled orders they have, where more unfilled orders are potentially added to the market. And one more thing, we want to be on the right side of the market. Okay, we want to be on the right side of the market because, guys, and please go ahead and answer this in the comments box as well. Anyone has been trading for a while, and after trading for a while, you kind of concluded, oh my God, if I simply had taken all those trades, but instead of going long, I went short, and instead of going short, I went long, then I would have made money. Anyone has ever been in a situation like that where you felt like, oh my God, if I had done exactly the opposite of what I've been doing, I would have made some money, right? So, and again, somehow, this is not an easy question to answer. I'm just realizing that as I'm phrasing it, because somehow I'm kind of asking you to acknowledge, publicly that, you've been taking some losses. So, not too nice of me. But I don't mean it in that way, guys. Okay, I mean it in the way that, even before you start planning on buying, you need to ask yourself the question: should I be a buyer? Even before you start planning yourself a trade for you to short, you should ask yourself the question, is it the right time for me to be a seller, right? And that's where I'm going, right? So we need to combine all those things together, and then you put it together in the form of a method with rules, and you follow the rules with discipline, and it has to help you guys, okay? Because it's gonna help, it's gonna increase your odds, okay? And so we need to end up with all these long-lasting explanation to end up being a series of very simple rules, not too many, but simple, for you to follow with discipline and precisely do that. Okay, that's my goal. That's where I'm going. So let me take a look at your comments. Okay, Babu, can we combine the DMI? Yeah, yes, absolutely. So in today's sessions, Babu, and this is why earlier I was talking about everything I'm going to be teaching is going to be modular. So in the part of the planning the trade, the timing the trade, all those things, I'm just going to be using the moving average and the UFOs because we've been doing that for a long time in the Tuesday session. So I will not vary that not to confuse anyone. But certainly if you have another set of rules or you want to use the rules I covered on Friday when we did the TradingView app introduction to the world, again, you want to do that, certainly you'll be able to do that and add everything else that I'm going to add on top of it. Certainly. Bill Nelson, absolutely, as price can blow through support and resistance on smaller time frame. Very well. Pavnit, I have taken big losses and small profits, want to change this. I really appreciate you made this comment because this is a classical consequence of being on the wrong side of the market. Okay, I had experienced that myself in my own trading results when I was new to the markets, where many times I will be like, yes, I caught a bounce, but it's such a tiny one. And then it went against me all the way. Oh my God, if I just did the opposite, right? And so what was it? Well, probably you were trading long when a downtrend was about to begin, or you were trading short when an uptrend was about to begin, or you were trading long too late when the uptrend was already about to die, right? Or vice versa with the downtrend. So again, there are multiple things that we need to put in place all together to avoid those problems and then find this beautiful balance with the probability, the risk, and the reward. Okay, and that's when your account will really, really thank you, because now the account, your equity curve is just gonna go up. Okay, when you do that. So good. So anyway, very long introduction, guys. I'm 100% aware of that. Okay, but it's critical for me that I have the peace of mind of knowing that all of you understand exactly every single word I'm going to pronounce starting from now, putting on the side my accent. But from the point of view of the concepts and the theory on how we trade and how the markets work, it's very important that we speak the very, very same language so we can be precise with the rules. Okay, guys? Good. So we need to look at rules, but I need to touch on symbols, okay? Because the first rule is going to be to look at the bottom chart, okay? So the first rule, okay? So let's begin typing the rule here, okay? Oop. So let's begin. Okay, my Word document is playing a little bit of games with me. Good. So I cannot believe it. Okay, now. So let's begin with the rules. Okay, let's begin typing rules. Okay, and one rule I'm gonna phrase, and for kind of like to be very descriptive at first, I'm gonna phrase the rules, okay, in a way that is quite lengthy. So that way you have a proper understanding of what the rule is about. Okay, and something I'm gonna ask you later on to do. And it's gonna be a little homework, okay, guys. I'm counting on you. I'm taking your word. You guys told me that we're gonna work as a team. So something I'm gonna ask you to do is that from Sunday to Sunday, I'm gonna ask you to come up with a very short name for the rule, okay? But when I type it, I'm gonna be very descriptive and add a very long sentence to explain the rule. But in the end, ultimately, a few Sundays from now, we'll just have like 2, 3, 4, 5 words per rule. Okay, and that would be a very nice definition of what the rule is. Is that making sense? But I'm going to be more descriptive so you get a full understanding of what I'm trying to do. Okay, so the first rule is going to be about make sure that you are about to trade in the right side of the market. Okay, so I mean, think about it. This is about saving time. Okay, this is about saving time because you could find yourself looking at all the parameters of the trade, follow all the rules, and conclude, okay, you know what? If I buy at this price, I have a stop at this price, and I have a target at that price, that's a good trade. It's a good risk management. It makes sense, blah, blah, blah. And then you look at the market and you're like, oh, wait a minute. I should not be going long. And my trade was to go long. So, you know, I'm trying to save you time. So the first thing I would like to do in the methodology is first, identify if you should be going long or you should be going short. So, and therefore, if the answer to this question is you should be going long, then you will only be looking for buying opportunities. If the answer to this question is you should only be going short now, so then the answer would be we're going to be looking for sell on field orders, red UFOs, and be shorting. We're not going to go long because the first step would be requiring us to only go long. Okay, so that's an important step to be taken again. To avoid getting yourself into trouble, okay? Now, having said that, you could be a trader who trades multiple time frames and multiple styles and multiple methodologies, and you find a high quality opportunity to go long the S&P while you find at the same time a high opportunity to go short the S&P using different time frames or different rules or both. This could happen, okay? But since I'm going to be using one methodology at a time only, at least for now, so then my first rule would have me determine if it's time to go long or to go short, okay? And I'm not going to give myself the chance to go long and short at the same time. I will just pick one, okay, for now. Again, as I said, we can get more complex and more advanced later on, but not at this point, okay? At this point, we're going to keep it simple, and normally simple is also more profitable, okay? So no need to, you know, load your account with 25 million different trades. You know, just take the high probability ones and enjoy your life, okay? That would be a much better way on how to trade. So what we're going to do is make sure that you're about to trade in the right side of the market, and somehow what I'm talking about here is to identify the trend. Okay, identify the trend. And here, you know, I'm just gonna, you know, underline and make the word trend, you know, italic, because there are so many different theories in the marketplace that talk about trend and how trend makes sense or how it doesn't make sense, or how if you trade with the trend you're late, or what if you enter the trend too soon is not good, or what if you got a trend in a time frame and a different trend in a different time frame, and you could look at trend and go completely crazy. And by the way, many people actually, I've seen it in the industry all day long. Many people in the industry, including certain brokers, including certain educators, including certain newsletters that you see out there. And I don't mean to say anything bad about anyone, don't get me wrong, but I've seen it often enough in the industry where some people overcomplicate trend on purpose, because if you overcomplicate trend and you don't give a specific instruction, right? You can always then justify, why the opposite of what you said was going to happen. Okay, so and again, this makes a lot of sense in the world of market analysis. And please do not get me wrong. I know I'm touching on a very sensitive territory here. Do not get me wrong. But you also need to understand that there are some market analysts that make a living doing market analysis and trading. And there are market analysts that only make a living out of doing market analysis and doing advice, or just market analysis and nothing else, and they make a living out of selling reports or a newsletter. And therefore, to them, is very, very, very important. For that last group, it's very, very, very important to always have a way to justify what happened. Kind of like, and again, I'm just going to say something that may sound funny to some of you. Not sure it's a good example, but hopefully it will work, which is that it's kind of like the world of weatherman, right, on TV, where you can always have a prediction, but then if the prediction does not become a reality, then you can always show a new picture of the satellite that says, oh, but we were not expecting this to happen, and this is the reason why in the end there is no snow, right, or whatever. And again, and I'm not saying this as a negative critique to that particular group. I'm just saying to make sure that you understand that you want to fall into this type of definition of trend, because our job is not to collect fees out of producing a report that explains what's going to happen next and charge for the report. Our job as traders is to plan a trade, put money on the line, catch a move, and ride a move, and profit from the move. And you may be right and you may be wrong, and you still put money, real money, your money on the line. And if the market moves and it moves against you, you lose. Where that market analyst, doesn't lose, because that particular type of market analyst, they make a living selling reports, and the only thing they need is a tool to explain why it didn't happen the way they said, but they didn't lose, right? So they charge for the report, where that's not our case. So our job is not to be always right, okay? It's not to always have an explanation. In the job of a trader, there are always cases where you don't know why something happened, but you better take it, because it's a matter of being humble enough and saying, hey, you know what, I was wrong, or whatever happened, but today I lost some money. And then in that situation, the key is to minimize the size of the loss, so the loss remains small. So you still have money in your account, you don't hurt your account, and you have money for new trades that will produce better profits, and overall your equity curve goes up. So it's not about being right. It's about being right often enough, knowing that you'll be wrong too. And when you are wrong, lose little, and when you profit more. That's trading, okay? And therefore, it's very common, I've seen it for years, that traders like us, out of passion and curiosity and a strong wish to learn and grow and know more stuff, you end up reading stuff on the internet that is classical information that some groups of professionals use in the marketplace that overcomplicate what trend is, and always gives you kind of like a backdoor escape in case the trend didn't do what you thought, that's why, but again, that doesn't help a trader. So long story short, the reason why I talk about trend in that first step is because we need, as I was saying, we need to decide something very important, which is it time for me to go long? Is it time for me to go short? This is something that needs to be clear in the mind of a trader before you even execute, before you even plan a trade. And this needs to be done in a way that is mechanical, that is high probability, but also knowing that sometimes you'll be wrong and then you'll take a loss, and it's part of the game and it's okay. But you don't want to overcomplicate your reading of the trend. You want to keep it simple. And the reason why we're going to care about it is because statistically speaking, what the trend does for you is this. So listen carefully. It's very simple, but very powerful. Trends tend to last. That's it. It's very simple. Trends tend to last. And because of that, if you trade in the direction of the trend and you do it at the right time, which is the time where you got the on-field orders that belong to the big players, and at the same time where you hit that moving average, where the computers may add on-field orders that were not in the market together at the same time where you have on-field orders, and you do all of this in the direction of the trend that again tend to last, that's why it's called a trend. Again, you are adding another element that will impact positively your probability. So could you trade against the trend? Yes. Of course you could. But what is the trend in the first place? So it's whatever you want to define it. It doesn't matter. What matters is trend tend to last. So what you need to have is a methodology that tells you something about the trend, so you know if the trend is up or down, so you can position yourself in the direction of the trend, because since trend to last, it will enhance your probability. Knowing that sometimes you'll be wrong, because your definition of trend may not be accurate, or maybe the trend just changed because some event or some whatever, and then everything changed, and therefore that day you got stopped out. And we'll talk about risk management, not a big deal. Okay, guys. So let's not overcomplicate. And by the way, a minute ago, Babu on the comments box was commenting on a little exercise I did on Friday when I did a trading view session. By the way, anyone was in the session on Friday with us when we did the trading view? I'm just curious to know if some of you were with us, and even more curious to know, how did you feel the session went? Did you enjoy the session? Was it useful to you guys? I would love if you, even though I'm diverting a little from the subject here, but I would be curious to know. So the reason why I'm pointing at the session on Friday is because of Babu's question before. So on Friday, I was looking at the trend definition with an indicator called Directional Movement Index, which is called DMI. Well, now, today, I'm not looking at DMI, I'm looking at a moving average. So here's an example of two different ways to look at a trend. Maybe some of you are looking at trend lines, and you look at pivot highs and pivot lows, which is a classical way to do it. Maybe some of you look at three moving averages, and only when three moving averages are moving in the same direction, you call the trend is up or down. So again, the sky is the limit. But the bottom line is, that you need to have a mechanical, simple definition of trend. And the reason why we do that is because trend tend to last. And because they tend to last, they are likely to produce profits that are greater in the direction of the trend, and therefore losses that are lesser against the trend. So if you were to position yourself against the trend, there are ways on how to do it, and it's not crazy, but this is not the methodology we are discussing today. The first step is to get ourselves out of trouble first, and therefore I am repeating myself one more time because this is such a critical concept. We are getting ourselves out of trouble first by making sure we are going to be on the right side of the market first. Okay? Some of you acknowledge in the past this has been your problem. There are a million ways on how to trade. We even said you can use the AutoUFOs by themselves with nothing else. So you could certainly trade against the trend, but you will enjoy bigger losses and you will enjoy lesser profits. I rather enjoy bigger profits and lesser losses instead of the opposite, and trend will do that for you, no matter how you assess it. So let's not make it complicated, okay, guys? Which I may have made my explanation a little complicated because I wanted everybody to understand my point, okay? So hopefully you guys with me. Good, I'm just reading your comments. TT2L, love it, Angelo. love it. Thank you for your comments as well when it comes to the Friday session. I'm just reading you guys. Yeah, Mario, I hear your comment about sometimes the trend assessment was against the assessment of other traders. Okay, get it? Okay, what's the bottom line, guys? It doesn't matter. What matters is that you have a rule and you follow the rule with discipline. Okay. Now, of course, the better your rule is, the smarter it is, the better. Okay, but you could certainly use other rules and it's still good. Okay, so the question is that you always need to have the key is that you always need to have this question for you, which is what side of the market should I be in? Okay, so make sure you are about to trade in the right side of the market. This is key, my friends. Okay, now how are we gonna do it? Okay, we're gonna identify the trend. How are we gonna do this? Well, we're gonna do this by using a 9 EMA. Okay, and looking at the prior candle close. Okay, so let's talk about this. Okay, because little by little I'm getting deeper into the rules, and notice that I'm gonna be building, a little bit of paragraphs here per every rule, and then I need you to help me to summarize the whole paragraph in maximum 5 words. Okay, and that's gonna be a little homework for you. Next Sunday, when we start the session, I will be asking you, hey, what's your suggestion for rule 1? Hey, what's your suggestion for rule 2? And we all together will be putting the rules in place. Okay, so now, why the 9 EMA? Well, again, we're using the 9 EMA. I said it earlier very quickly because it's a standard EMA that comes by default in many platforms. And in this case, I want to use the one thing that most people could use, because the most people could use it, the higher the probability added orders will enter the market when I enter the market. If I was to use a weird moving average, I don't know, let's say I use the 71. I don't know who uses the 71, but certainly the 9, many people uses it. Why? Because it's a default moving average in many platforms. There are many moving averages that are default, okay? So there are platforms that come with a 20 by default, the 50 by default, the 200 by default. But here is another indication I would like to also put on the table. My recommendation would be to use a short period. Short period. Why is that? Well, because market conditions change. And, when the markets were traded manually by people, let's say 1950s, 1960s, there were no computers, very few people on the floor would trade. The speed of events happening would be lesser. The speed at which the news would propagate throughout the world would be lesser. In other words, when a market would pick up an uptrend, it would be quite stable. When a market would pick up a downtrend, it would be quite stable as well, and that's it. But nowadays, even though, funnily enough, in the lower time frames, you look at the S&P 500 in a monthly time frame, and this is the biggest uptrend we have seen ever in the world, right? So, which is kind of funny because it's almost a contradiction to what I just said. But normally, when you look at lower time frames, okay, nowadays you have a lot of zigzag action because you have a lot of computers trading, getting long, getting short, taking advantage of multiple time frames, taking advantage of multiple fib numbers, multiple moving average numbers, multiple algos, multiple all sort of things, and therefore the market, even though overall there are more liquid and more continuous than ever, but when you zoom in for the intraday, you end up seeing more, let's call it noise. And noise is also equal to opportunity if you know how to trade the noise, but at the same time, it's also more difficult to assess, or if you ignore too much of the noise, well then maybe the trend has totally changed, and when you call it a change of trend, it's way too late because the trend is about to change again in the opposite direction. So my suggestion in the market in which we trade, in the world in which we live, is to not to use a very long period for your moving average. Like if you were to use the 200 EMA, well, could it work? Certainly, because computers do trade it. Because many books around the world talk about the 200 EMA, and therefore many people watch it and many people trade the 200 EMA. So it could certainly help. But first of all, if you use that as a trend indication, maybe too late. And second, the amount of trades that you would get to execute is only very few. Okay? I mean, take a look. If I if I use this 15-minute time frame, let me use the continuous symbol because I want to use a lot of data. And by the way, I need to talk about symbols. So if I load a lot of data here, right, you see that the 9 is going on top of price all the time on top of price. The purple line is on top of price all the time, right? And basically, you know, you have a potential opportunity to go long or short every time price is close to that line, right? What happens if I make this line to be 200? Well, if I make this line to be 200, then price is going to be away from that line. And here it bounced from the line. Here it bounced from the line. But basically, you know, since here again in 329 or 328, it bounced from the line too. But basically, since 328 until today, you had 3 or 4 opportunities to trade, which doesn't even give you one intraday trade. And what if this happened at 4 in the morning? So, you know, it's not active enough. So my suggestion, and again, I'm giving you a lot of whys. I'm not just giving you rules. I'm explaining why. My suggestion of using 9, it's number 1, because it's a classical one, and you want to attract as many people as possible using the same average you use yourself. But the other reason why is because that way you will have many times, you know, where the price crosses or touches the moving average and bounces and does things around the average, and it happens many times. Like every candle is 15 minutes, so it's like maybe like every 1 hour you can have a trade or something like that, right? So I'm not saying they will all be profitable, but at least you could execute. Okay, so you can be more active, which is the purpose of what we are doing. Since today we are talking about intraday trading, which by definition is more active. Okay, and let me take a look at the chat box to make sure everybody's with me. Can you clarify the difference between the TradeStation and the TradingView AutoUFOs? Brian, is functionality. The algo behind the scenes is the same, so you get the same zones with both apps. Okay, it's the same thing, but functionality is different. TradeStation will give you a more advanced functionality compared to TradingView. Even though TradingView will give you a greater amount of markets that you could chart that TradeStation doesn't have data feed for. Also, TradingView, you can use it on the go with your tablet, with your mobile phone, etc. And you can have UFOs on your phone, where TradeStation, you need to run it on your desktop application. So, I mean, it's in one hand, it's the same thing. In the other hand, it's different. Okay, so it depends on your needs. It depends on which broker you use, and obviously, in a perfect world, I mean, you have access to both. So if you are on the go, for example, we'll talk about trade management. If you are on the go, you can see your UFOs on your mobile phone. For example, if you are at home or in the office and you're trading, then you have your TradeStation. So again, that would depend on your trading plans and what you want to do and which brokers you use and things like that. So bottom line, the algo is the same, but the functionality is a little different. Okay. Also, TradingView will give you 4 red UFOs and 4 green UFOs maximum, because on how TradingView draws things on the screen, there is a limitation on how many objects you can have on the screen. Because of course, you know, let's say you had 20 UFOs on your cell phone, well, probably you would just freeze your cell phone or get out of battery in 10 minutes because you would require so much power, processing power from your cell phone to be able to have too many UFOs. So TradingView limits it to 4 UFOs that are red, 4 UFOs that are green, where with TradeStation you can have as many as you want depending on the time frame that you use and the amount of candles that you load on the chart. Okay, so again, it's functionality. Okay, Dhide, please say a little more about looking at the prior current close. Yes, getting there, David. Babu, I am confused with multiple choices on future subscriptions and do not know which is the right choice given under extra data for the TradingView website. Can you give me an insight? Okay, good. I would love to do that, Babu, but I'm just concerned that if I get too much into TradingView, I'm diverting a little too much from what we're supposed to do today. So what about you do this, Babu? What about you take a screenshot of what you think is what you need from TradingView and you send it to us on an email to reach@tradewithufos.com, and we'll take a look, we'll reply on an email. And what we could do as well is schedule a session, maybe we can call it Q&A for TradingView, and we can just get together to just do Q&A for TradingView. Maybe we can even do Q&A for TradingView and TradeStation, and all of you that are using the app can join us, and we don't talk about trading. We just talk about the app and or data fees or brokers and stuff like that. You know, would you guys like that we do that? Would you like that we put that on the schedule one of these days, next week or the week after, something like that? Yeah, Brian, exactly. You can use both, and that way, you know, that's great. Then you have your, yeah. Stocks is free data feed on TradingView, so it's great. The Yeah, Roberta. Yeah, I'm reading your comment as well, Roberta. So for you to get the probability measurement, okay, just double click on the box, okay, and you click on yes, and then that will bring you to the inputs, and where it says show UFO stats, just make sure you have true. You type true manually, and the moment you click OK, you will have that figure there. Okay, but Roberta, this your question is, you know, it's motivating me to suggest that all of you should be reading the user guide. Okay, so if you get into our website, okay, and you type www tradewithufos, let me type it for you guys, tradewithufos.com/guide. If you do that, you can download the PDF format of the user guides for your TradeStation, right? And then you will take a look at the user guide, because all of this is explained there. Okay, good. So anyway, so let's keep going. So now that you know a little more about why we are setting rule 1 to be the way it is, which is make sure that you are about to trade in the right side of the market, identify the trend. And again, we do it because the trend tend to last, okay? But again, there are a million ways to identify the trend, so we're just gonna pick one. And the one we're gonna pick is a short moving average. And the reasons why we're gonna pick a short moving average, I just told you why short. So short, because in the markets in which we live, where computers control the market, a long-term moving average may not be as relevant. Number 2, if the moving average is long-term, it may not give you trades enough, okay? Number 3, which I have said, why a moving average instead of DMI or pivot highs and pivot lows? Why? Well, because, you know, you have an extra benefit. What's the extra benefit? Well, the extra benefit is that the moving average represents a price where the institutions may add on-field orders. We talked about that at the beginning. So you are killing two birds on one stone. Not only the moving average is giving you a reading of what is the trend condition, the moving average is also telling you a price where if you were to buy around that price, in other words, if you were to have a green UFO above, lining up with the average below, now you have on-field orders together with potential for new on-field orders to be added in the context of an uptrend. So in very little time, by only looking at the bottom chart, look at how much information you put together, that all of it is adding odds in your favor. Okay, so that's why. Okay, and then there is one more reason, which is the last one, and now I'm back to you, David. Because it's easy and mechanical to assess. Because that way you are not going to be subjective and be in a situation where you're like, oh, I feel it's an uptrend, but I'm not fully sure. No, you will not be in that situation. What you're going to do is look at the prior close. Okay? So this is the prior close. You don't look at the current candle. The current candle is where you trade. So you will not look at that one. You will only look at the prior close and compare the prior close with where the average was when the prior close took place. And if the prior close is above the average, you would simply call this an uptrend. And if the prior close is, like here, below the average, you would simply call that a downtrend. And there is nothing else to think about. Done. Okay? Now, I'm not saying that because it's an uptrend, downtrend, you're going to buy immediately. No, there are more rules. This is only rule number 1. Okay? There are many more rules that we need to add here. But this is what we're going to do. So we're going to use the 9 EMA and looking at the prior close. And we will be comparing that close that closing price with the average price on that, the average price on that candle. And if the close is above the average, then you will call it an uptrend. And if the close is below the average, then you would call it a downtrend. That's simple. And again, this is just the beginning, but it's very neat because now think about your thinking. So you put yourself on the chart, you haven't even looked at the chart above. Okay, so let's pretend the chart is not even there. Just by looking at the chart below, you are looking at the prior close being above the average, and what are you thinking? Okay, let's look for green UFOs. That's it. You don't even care about the red UFOs. You are only looking for green UFOs. Why? Because you just decided that in order to stack odds in my favor, I better be a buyer. This trade will be of a higher probability if I am a buyer instead of being a seller. Why? Because I just defined the trend as being an uptrend. Okay. Now, could you define the trend in other ways? Yes. I think I repeated myself multiple times. I guess it's no need for me to do it again. But this is powerful. That's the bottom line. It's not only simple, it's powerful. So, guys, comments and questions. Go for it for this step one, because of course we have more stuff coming. I have one thing to add, by the way, to step one, but I need to see where you're at. Sandy, the probability measurement does not display on TradingView. That's another difference. Okay, and again, it's how TradingView displays things on the screen. It's not possible. So the way you do the calibration in TradingView, if you look at the user guide of TradingView and you compare to the user guide of TradeSession, the calibration process with TradingView is different because we don't have that number. Okay, but you still have a way on how to calibrate and get measurements of probability. We did that on Friday, isn't it? Ellen, what if you are trading on hourly chart? Do you then change the EMA to a larger time frame? Very good. So you read my mind, Ellen, because I just said we have something missing on rule one, which is the time frame. Okay, so I need to talk about time frames, which will answer your question, Ellen. Getting there. Very simple, very powerful. All good here, Jose. Isn't that make it more choppy trade? If you were to use it on your own, Miral, I 100% agree with you. If you were to only buy because the average is up, or only sell because the average is down, or the close is above or the close below, then yes, it could be very choppy. Okay, but we have more rules to avoid the choppiness. Okay, and you know, I'm gonna use a strong word here, if that's okay. Our salvation, right, is gonna be what? Well, it's gonna be the UFOs. That's the salvation. When you put it all together, the UFOs are gonna keep you on the right side with the right timing. You will avoid the choppiness, and if any, if the market is about to become choppy, at least you'll be hitting those target ones when we talk about exits. So getting you out of the trade for break evens. So if the market is about to be choppy, there is not money to make anyway, but at least you have break evens. You will not have losses. Okay, so we'll get there, Mital. A good, very good comment. You'll see. Orlando, using this rule, I did really well this trading week with the ES and the crude oil. Nice. Thank you, London Trader. Very nice, Ellen, as well. Wonderful, guys. Again, in one hand, I have this major, massive temptation. I mean, I normally talk quite fast, and I have this major temptation to really, really accelerate and just come up with all the rules. So you have the big picture. But again, I don't want to do that. I'll do that on the Tuesdays. During the Sundays, I want to give you detailed explanation about the why. Okay, because on the trading days, we don't have time for the why. So I want to add it here, which is going to be very important. I know for some of you, for example, Orlando, you've been using the methodology this week, so I'm sure that you would appreciate if I go a little faster. But at the same time, I would like to ask you all to bear with me, guys, okay, because it's important. So time frames, okay? So time frames, okay? When it comes to time frames, for time frames, what I'm going to do is I'm just going to make time frames comments, okay, I'm just gonna make time frame comments in another page, okay? Because the idea is to produce set of rules that could be used with no matter the time frame. So then, in order for me to be able to do that, I'm just gonna have a time frame section, kind of like separate compared to the rules. And then we're just gonna give the time frames 2 names, okay? And we'll apply the rules to the proper time frame, okay? So for the time frames, we're gonna use 2, okay? We are going to use 2 time frames. You could use 1 only. You could use 10. But what's the problem if you use 10? If you use 10, it gets too complicated and it's too tedious. If you use 1, it's okay. And by the way, you have seen me, especially when I use options, many times you have seen me use 1 time frame. Okay, and why is that? Well, because I don't mind to lose precision. Because with options, you could trade with no stops. Or you could also trade for non-directional trading where you don't care that much about precision. So in that case, then you could use 1 time frame. But here we are doing intraday trading, so we're gonna use 2 time frames. Okay, but how are we gonna call them? Well, the first time frame, I'm gonna call it the common time frame. So what is a common time frame? Okay, the common time frame is a time frame that many people uses. A time frame that is classical, a time frame, let me write it down. It's a classical time frame. Many people use it. It comes by default in many trading platforms. Okay, so that's a common time frame. So we'll use one of those. Okay, and why? Because again, trading is a competition game. So you need to anticipate what our competition is doing, what others are doing, okay? In this example that I have on the left, where below I'm using the 15-minute time frame of the S&P, right? And above I'm using the 2-minute time frame of the ES. Well, the common time frame is the 15. The 15 is a time frame that is available in all trading platforms. The 2-minute time frame is not common, okay? The 2-minute time frame is not a common time frame. Okay, it's a time frame that some platforms may provide it, but not all platforms may provide it. It's actually a little weird. Okay, few traders use the 2-minute time frame, so that's gonna be our time frame. Okay, it's gonna be our unique time frame. Okay, and by the way, guys, I would like to give you the opportunity to name it. How would you like to name it? Okay, if one of the time frames we're gonna use is gonna be the common time frame, the one everybody uses, and the other one is going to be a weird time frame that only us use, how would you call that one? Okay, that's going to be that unique time frame, okay, that only us use, or very few people use, which is a lower time frame which is lower time frame when compared to the common time frame. Okay, so our unique time frame will always be a time frame which is lesser. Like for example, 2 is less than 15, right? So let me see your suggestion. I love it, Brian. I love what you said. Okay, let's call it edge. Okay, it's gonna be our edge time frame. So what is the edge time frame? The edge time frame is gonna be that unique time frame. I love it, guys. Okay, guys, you're really making my day because I love to do this together as a team. So the edge time frame is gonna be that unique time frame that only us use. So that way we will come up with readings about the market that are not the classical reading that everybody uses, so we can be a little more precise. And the reason why this is going to be important is because some of the market participants out there are mean people. Okay, let me explain what I mean by that. For example, guys, have you ever heard out there a myth that talks about market makers running people stops out and then the market moves your way right after you have been stopped out, or market makers taking the other side of their customers' trades, or market makers getting into a trade and then passing the delivery of that stock, for example, to a trader 1 or 2 cents at a different price, and they do arbitrage against their customers, isn't it? Yeah, Orlando, yes, London trader, edge it is, okay? Thanks for that, Brian. Very, 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 very beautiful, powerful, creative word. Thanks for that. Yes, so Buna, this happens all the time, isn't it? This happens all the time, isn't it? And some people think that I'm unlucky or whatever. It's not unlucky, guys. In trading, there is only 2 things that could be done: is buy or sell. And for you to buy, someone has to sell, and for you to sell, someone has to buy from you, and therefore for you to profit, someone has to lose. And there are many market participants, such as brokers or market makers, that are in the business of collecting as many trades that have on the other side a person ready to lose. And most of the times, those are the uneducated traders. And what are the uneducated traders doing? Well, to be honest, the uneducated traders are not really uneducated, because if you are uneducated, normally you don't trade. What I mean by uneducated trader normally is more a person who has read a couple of books, watched a couple of videos on YouTube, attending a couple of trading seminars, and get some information on their mind about trading and investing. But the problem, it's just, let's call it generic information available to everybody, such as classical technical analysis or classical techniques of, candlestick patterns, or, all those classical indicators, and using the crossovers and all that stuff. And again, nothing wrong from a point of view of having knowledge about the market, but because many people that are not professionally educated, they are educated at that level, but not professionally, because of many people are using those techniques, using regular, common, classical time frames, okay, well, brokers are watching that. And by the way, many of those brokers are the ones publishing those books, so they know exactly how people trade, and therefore they basically trick them a little bit into being stopped out and so on, because they kind of know what is going to be their entry point based on what's on the screen. Like, for example, just to give you one example, which is very classical, you have a support, right? A support line. Those support lines that market analysts talk about on TV, right? This classical horizontal line on a chart, and price comes straight down to the support and pauses, right? And gives you one of those doji candles, right? Which is like this candle here at 1345, right? Just give me 1 second, guys. I need to have a little sip. Just 1 sec, guys. So I'm back, guys. Thanks for that. So let's say you find one of those doji candles, right? So doji is a word. I don't speak Japanese, but in Japanese I understand doji means indecision. So therefore, some theories about the market suggest that when you have an indecision candle and this is happening at a support price, then the market is about to move up. And if that's the case, you could buy the next candle. The moment the next candle goes above the high of the doji candle, the moment the market goes above, that's where you are supposed to buy, expecting the move to happen, which it did. And if it doesn't happen below the pivot low of the doji, okay, that's where your stop should be. In case the market goes against you, that should be the price where you have a stop. And in this case, okay, guess what? It worked. You didn't get stopped out. It didn't come to you and stop you out. Okay, and so if you did that, actually, that was a profitable trade. Congratulations. But what happens many times is that it does stop you out and then it goes your way. And why? Well, because basically everybody in the world knows, if you were to be that person, that your stop was there. Okay, why? Because it's written in every single book, in every single PDF file. I'm maybe exaggerating a little, but you get my point. So that's why for us to gain precision with the entry, I would love to use an edge time frame, which is going to be unique to us. which is not going to be common, which is not going to be a time frame that many people use. So whatever candles that we see in there, whatever UFOs that we see in there, may not look like what everybody sees. So basically our entries and stops are going to be located in prices that other people may not have them. And that's going to be helpful not only to be more precise, but also to minimize the probability of being stopped out. Okay, so perfect name, Brian. Again, love your creativity, my friend. Perfect name, because that name, that word summarizes perfectly what I just explained. Because using that special time frame gives you an edge. Okay. So in other sessions, let me go back up here. Okay, you probably remember on Tuesday sessions, I normally always flash this particular note where you see that for intraday time frame, we are either using the 15 and the 2, the 60 and the 5, and the 240 and the 15. So let's talk about it, because there is something right and something wrong here. And I want to talk about it with you guys, because now finally we're getting to these Sunday sessions where we have time to talk about it in depth and take this to the next level. So first of all, this column, right, with the 15, 60, and 240, this column represents the common timeframes that every single platform in the world has available and that people can use and trade with. So what are those timeframes going to be used for? Well, they're going to be used for you to plot your 9 EMA. Okay. Why? Because that way you are plotting a classical EMA, a common EMA, in a time frame which is common. So it represents a price which many people are going to be able to see, that will motivate many computers that become too big players to buy at that price, and therefore it becomes relevant for the trend assessment and also for this concept that we discussed before of having new on-field orders added in the market after you got in. So perfect. I think that the column on the left does not produce any question or anything like that. I think that the column on the left is crystal clear. If you have any question about the column on the left, please let me know. Okay, but I would say it's quite clear. Now the column on the right, okay, it's kind of like what I said, but not exactly, because if you look at the column on the right, this is going to be our edge time frame. Okay, that's our edge time frame. And for the 15, okay, for the 15, which is the first combination, we do 15 and 2, which is perfect, because the 2-minute time frame being available in some trading platforms is not available in all of them. And even if it's available in some trading platforms, I would say most people would not use the 2-minute time frame. So it does qualify very well with the definition I said before. I still have a problem with it though, which I'll express in a minute. Okay, but the biggest problems, and probably what all of you are thinking, is that with the 15, with the 50, with the 60, I'm using the 5, and with the 240, I'm using the 15. And you're probably thinking, Jose, wait a minute, the 5 is common, the 15 is common, so why are you calling the 5 and the 15 an edge time frame? Okay, well, and the reason why is because, we're going to change that, by the way, but the reason why is because up to this point, I had to navigate in those Tuesday sessions in a way where I had to give you tools that work with the majority of you, knowing that some of you have platforms that don't allow for edge timeframes, and some of you do have platforms that do allow for edge timeframes. So starting from now on, what I want to do when it comes to edge timeframes is to give you different possibilities. Give you a possibility if you were to use a platform that allow you to really customize your timeframes. For example, with TradeStation, I could do, for example, instead of 60, right? Instead of 60, okay, I got 60 below and 5 above, okay? So instead of 60 and 5, which is what we have been doing until now, okay, I could do 60 and 8. 8 is an edge time frame. It's not classical, it's not common, it's not available in all trading platforms, okay? But, if I had done that before, well then, many of you would have never been able to use the Tuesday methodology, okay? But it gets better, because apart from using those minute time frames that could be fancy, we can also go the route of using things such as 5,000 share bars. Where now, once my chart loads, the beauty is that every candle will have the same weight on my chart, which is 5,000 contracts traded per candle. No matter the time of the day, every candle represents 5,000 contracts traded, right? And why is this important? Well, take a look. Take a look. So I'm going to have here on the right the S&P. Let's go, for example, for 5-minute time frame, which is what we had before. Okay, and I'm just loading some candles here until 4-4. So let me load candles here as well until 4-4. 4-4. Here we go. So notice the difference. So I got 4-4 on the left with the 5,000 share bars, and 4-4 on the right with a 5-minute time frame. But what's the difference? On the right I got 1, 2, 3, 4, 5, and 6 UFOs. On the right I got 1, 2, and 3. Not only that, if I was to count the amount of candles available since 4-4 until current date, we are talking about 486 bars, right? If I was to count the amount of candles since 4-4, more or less here, to current date, well, actually, in this case, it's actually quite similar, okay? Not the same, but quite similar, 438. So, but what's my point? My point is that think about the relevance of let me see. For example, I'm just looking for a good example. So, like this UFO here was created at 7:45 p.m. Chicago time. Well, at 7:45 p.m. Chicago time, the markets are closed. The US markets are closed. The future markets are open. But certainly that UFO was probably not created by a US institution. It was probably created by an Asian institution because 7:45 p.m. normally US is done trading. Does that make sense? So probably there was an Asian institution or something like that creating. And what happens normally is that institutions in different side of the world may have different quantity of orders to get filled. I mean, a hedge fund in a city such as Singapore would be called a hedge fund, with $30 to $50 million under management, they would call it a hedge fund. Where in the US, probably a hedge fund is not a hedge fund unless that company is trading like $200 million. The US market is the biggest in the world. And it doesn't mean that the US doesn't trade Asia, and it doesn't mean that Asia doesn't trade US, but the quantity of on-field orders may be different. So if you look at charts which are time-based, which is valid, nothing wrong with that, but the problem is that from a point of view of precision, you would be assuming that all candles have the same weight, where the reality is that depending on the time of the day when those candles were created, then the weight may be different. Where if you were to not to use time-based charts and you were to use candles based on trading activities such as volume, or even if you want to be a little more fancy, maybe you do ticks. Okay, so I'm looking for a 1,000 tick chart here. Okay, now every candle is created by 1,000 trade per candle, no matter how many contracts per trade, but it's 1,000 trades per candle. Well, now you end up with, again, a different picture. And the beauty of the tick bars and the share bars is that those two types of charts are independent of time. And every candle has the same weight no matter the time of the date, no matter if that candle was created or that pile-off on field order was created because of a US institution or Asian institution or European institution, it doesn't matter because every candle has the same weight because this is how they're uploaded on the screen. It's based on ticks, it's based on volume or shares. Where time is based on time. And the amount of contracts or shares traded at 4 a.m. is not the same compared to 10 a.m. Okay? So when it comes to using edge timeframes, we're gonna be looking at edge timeframes in two different ways, which is gonna be one basic way on how to do edge timeframes will be to use weird timeframes based on time. But another way to use edge timeframes will be to use timeframes that are not based on time, such as shares or ticks. So we're gonna be able to get much more precise because now every candle has the same weight. Okay, and definitely, now you are getting into a territory where extremely few people from the public, okay, those uneducated traders I was talking about, which they have some knowledge about the trading, but definitely they only look at the 5 minutes, the 15 minutes, the 60 minutes, the daily, the 1 hour, but they certainly don't look at the 3,000 share bar. They don't look at that. Does that make sense? So now this may give you an edge, which is additional to everything I said before. Okay, so time frames is gonna be a very important part of our approach. Okay, so what I would like to do is, and we're gonna do it now. We're gonna build a table together of which time frames to use depending on your trading style, how active you wanna be or how not active you want to be. Okay, and also which time frames to use as edge, depending if your platform provides share bars and tick charts or doesn't, okay? Because some platforms do, some platforms don't, okay? So that way I'm gonna give you choices for everybody. But again, talking about the why, I wanted to make sure you all understand why we're gonna use a common time frames and an edge time frame, okay? Because most people don't think about time frames this way. Most people think about time frames like, okay, it's like you're zooming in. It's like you're doing an X-ray. You got the larger time frame, the smaller time frame. But I love what you said, Mario, a few messages ago, when you said that, but then you got contradictory information. One time frame is up, the other time frame is down. Some time frame tells you to buy, some time frame tell you to sell. What do you do? Okay, so it's not about using different time frames to try to have the sky and the moon and the stars to line up. It's not the case. The case is to add probabilities to our trading. Probabilities are added by looking at a trend. Trend tend to last. So we'll use the common time frame, which based on the definition we have will also happen to be a little larger, but it is not larger because we need to use larger. It's larger because it tends to last. So because it tends to last, it is common sense to assess the trend in a larger time frame because it tends to last. Is that making sense? And then we're gonna use the edge time frame to be more precise at our entries and also targets. Okay, so we're gonna be doing all of this. Okay, but let me take a look at your questions here. Okay, so I see Buna, I see your answer as well, Brian. Thanks for helping with that. The 6 minutes review. I'll be talking about all of this. Okay, guys, I'll be talking about all of this. We've been using that on Tuesdays, but again, we are still working on step 1, if you wish. So even though it's taking time, one step at a time, guys, because it's important to have this very solid method, with all rules like totally fully understood. Okay. Yeah, we are using edge to avoid the herd. Yeah, love it. Good points. Yeah, Buna, you are already using share ticks and very good, fantastic. Orlando, Jose, I have a recommendation. Yes, let me know when you are ready, please. I prefer to float my idea towards the end of the session. Maybe this is a good time, Orlando, because the last thing left, we've been 2 hours non-stop, guys. So the last thing I want to do is to build a table with the time frames, and then we'll call it a day. So if you want to phrase your suggestion, please go ahead. I'll do the table. We'll comment on the table if needed. Then we'll look at your recommendation, and then we'll call it a day. Okay, guys? So time frames. Okay, so let's talk about time frames. So we're gonna be building a table here. So let me add a table. Okay, so we're gonna add a table here. Okay, I'm gonna have a bunch of cells. Okay, I'll make this prettier in a minute. But basically, you know, one of the columns is gonna be the common time frame. Okay, so we're gonna have to define which is the common time frame we're gonna use. Another column is gonna be the edge. Okay, now when it comes to edge, I'm gonna have to give you two options. Okay, edge with minutes and edge with shares and edge with ticks. Okay, depending if you're going to be using tick charts or share charts. Shares is also known as volumes. Ticks is also known as activity. Okay, so tick charts, activity charts, volume charts, share charts is the same thing. And minutes is minutes. Okay, even though with minutes, I'm going to give you two choices. Okay, the common choice. Okay, the common choice and the weird choice. Okay, the edge. Okay, so we're going to have two choices because some of you may be using a platform or a broker that does not provide the choice to do, for example, like I did before, the 8-minute time frame. Okay, you may not have it. Okay, so let's begin with common. So when it comes to common time frames, okay, we're gonna be using the classical ones, and I would not recommend to go below 15. Even though if you tell me that, you know, you are super experienced and you are super fast with the computer and everything, well, maybe you could use at the 5, and then for your edge minute you can do the 1. Okay, but I'm gonna skip it if that's okay, and this is why. Okay, so if you look at the 1, okay, and here we are looking at the S&P, which is the most liquid market in the world. Okay, the problem with that is that this looks quite okay, if you wish, because this is the closing time, and at the closing time you got great amount of trading. But what if I get you know, in times more towards the middle part of the day? So you many times you end up with things like that, where, you know, basically this is nothing, right? This is nothing, and this is happening with the most liquid market in the world. I mean, if you were to look at things like the euro contract, for example, which is much less liquid, I mean, look at those candles, my friend. I mean, the UFOs is still doing its job on finding the UFOs, but I mean, let me zoom in this thing. Look at that. It's quite ugly. Okay, so the only way to be able to deal with these really would be in 90% of the cases, or 99% of the cases, would be with share charts or tick charts. Okay, so we'll need to talk about this next Sunday, because you will see how we're gonna have to develop certain rules, you know, for tick charts and for share charts, because the tricky part with those markets is that with those shares, with those type of charts, is that not every market is as liquid, and on top of that, liquidity changes through time. So we're gonna have to look a little deeper into how to decide the amount of shares or ticks. Okay, so we'll have to come up with a rule to do that. Okay, so basically, I'm gonna start with 15. Okay, I'm gonna start with 15 because 15 is gonna be the you know, the smallest time frame where I could have an edge time frame, which in this case is gonna be 2 minutes, you know, which is gonna be okay in most cases, even though in some markets the 2-minute time frame still looks quite ugly. But I would say in most of the biggest futures tradable products, you know, in big exchanges, normally 2 minutes, it's okay. Okay, now what if you don't have the 2-minute time frame in your platform? Well, if you don't have the 2-minute time frame in your platform, then let me do this. Okay. Then what you will want to do is it's to use the 5-minute. Okay, so if you don't have the 2, then you're gonna have to use the 5. The 5 is normally the time frame, which is the smallest time frame that you find out there in most platforms. Normally, well, actually, the smaller time frame that most platforms will have is the 1, but I already made a comment about the 1. So if you don't have the 2, then you go for the 5, okay? And that's it. Realistically, if you don't have the 2, I would say probably you should not do that, okay? You should not do that, and you should go for the next combination, which is gonna be 60 minutes, okay? And we have been looking at 5. Okay, we have been looking at 5 if you don't have any other type of time frame. Okay, so that would be valid. Well, if you do have the possibility to add edge time frames like TradeStation, you could input. So notice on the, if you have not seen that done before, take a look at the upper part of the screen here. Okay, because you know I'm just gonna either click there or click on the chart and type 8. Okay, and then blank space MIN. And when I do that, hit enter, and now it gives me the 8-minute time frame, as you can see. So with TradeStation, I could come up with very, very particular types of time frames. Okay, with TradeStation, as we all know, it's very powerful. It's a nice platform to have. So now, so this is a change that I will be start using on Tuesday, okay? We'll need to talk about the shares and the ticks in the next Sunday session because really I have a lot of things to discuss here to pick the right time frames, and those will make an even more impactful difference, okay? What if 60 is not the one you're gonna use? Then we would go for the 240 because again, that one, it's very classical. But if you look at the 240, then I was suggesting to use the 15 minutes, okay? So what would you want to do? Well, you will want to use the 21, okay? You guys notice anything about 8 and 21? Anyone notice anything about those two numbers? You guys let me know if you notice anything about those two numbers. They are fib. Yeah. And why do you think I picked those? Anyone guesses why? Again, it's all about the why, okay? And by the way, if you use the 9 or you use the 20, it's basically the same thing, okay? But what am I trying to do with the 8 and the 21? Well, you know, again, who trades nowadays the electronic markets? You know, who trades those markets? It's super fast computers, okay? And the programmers that program those computers, you know, if you have ever programmed before, you know that every time you program, you need to come up with variables, and you need to come up with inputs, and you need to come up with specific values that are gonna be fixed or vary, but be defined in a certain way by the computer program, right? And what happens? Well, for computers, for programmers, it's very, very simple to use a Fibonacci sequence, okay? Not only because traders use it, but on top of that, it's very simple for a computer to use it when it comes to deciding about which time frame to trade, for example, right? So the 21 and the 8 happens to be fib numbers, and therefore there would be valid selections for the time frames because not only they are those edge time frames, those weird, unique time frames that only us use, but guess who else use them? Also the institutions when they add orders, okay? Not the institutions when they try to trick people, okay, by, you know, identifying where people got the stops and running those stops out, and then the market goes their way and all that stuff. Not that. I'm talking about when the institutions add orders. So when just like the moving average, right, which is a potential opportunity for new orders to be added. Well, these fib timeframes also are a classical timeframes that people don't use, but computers do use all the time. So that's one of the reasons why we're gonna use it as edge. Okay, so basically 5, 5, and 15. Okay, the column in here is not wrong. It's gonna look very similar to the 2, 8, and 21. It's not gonna look that different, but it's gonna produce a little bit less of an edge. Okay, So I'm gonna remove the bold component, okay, because this would be only for the ones of you that use trading platforms that don't allow for the very fancy timeframes, because those fancy timeframes will provide an edge, okay, and that's the whole point that we are discussing here, okay. So again, for ideally, you don't even use the 8 and the 21. You will be using, the shares and the ticks. Okay, actually, it gets even better. We're gonna be using a combination between the 8 and the shares or the ticks, or the 21 and the shares and the ticks. And by doing that, you will have an edge, built-in an edge. Okay, so and that's gonna be even better. Okay, but yeah. So and you could certainly build more time frame combinations this way as well. Okay, so you could go ahead and keep adding, what if I do the daily time frame, what if I do the monthly time frame? So you can certainly do all of these, but now these would belong to the world of longer term trading, not intraday trading, and therefore would not require that much precision any longer, because probably you use options. With options, you could use options without the use of stops, the way we have done before, if you choose to. So again, my little, if you don't mind me to use a strong word, my little obsession with precision in today's session has one reason to be, and is the fact that we are doing intraday trading, and therefore it's all about catching small moves, getting small losses in exchange for decent profits, but they are intraday moves, so it's not big moves. So because everything is small, you have to be precise, right? And that's why we're gonna be using all those tools and more, okay? But anyway, I will leave the shares and the ticks for another session, because it would make today too long. And Orlando, I believe you had a comment. Let me take a look at the last comments here. Marcus, is this strategy timeframes only for ES, or can it be used for forex and futures? For all markets, Marcus. This is going to be for all markets. Okay, it doesn't matter the market you trade. The methodology will produce results in a similar fashion. Okay, and then you can backtest it as well, the way we did on Friday. So you'll see. Okay, good. So Orlando, Jose, I love your energy and enthusiasm to coach us and mentoring us. Thanks for that. We want to keep you happy and fresh at all time. Do you want to take a 5-minute break in the middle of the schedule? You are amazing, Orlando, and you have a very good point. And sometimes I put a little too much passion on the table, which may exhaust you a little. So very subtle way to ask me to take breaks on the next sessions. And I'll give you 100% right on that one, my friend. Good. Wonderful. Yes, so let's do that, okay? We'll be keeping a short break on the future sessions as well. I have the tendency to keep running, because somehow my muscle memory is the 1 hour sessions that we do on the weekdays, but these sessions on Sunday, we basically do double the time, okay? And really, I'm not shooting for double the time. It could be an hour and a half. It could be anything, but I think it's a very good suggestion, Orlando, so I'll take it, okay? Very good, Brent. Good. So guys, again, building the foundation for what's coming here. We discussed very, very, very important things today. Of course, when it comes to rules, we only came up with one rule, okay? So there is more to come. Little homework for next session, okay? For next session, everybody, when we begin, on the comments box, I would love it if you guys were to propose a name for that step 1, okay? The right side, the trend, you name it, just you guys propose a name, okay? And I'll take your suggestions, and then we'll see how we end up deciding on all the list of steps, okay? But at least, it would be great that you guys come up with a name, okay? So that would be good, and that way we do a little bit of teamwork, okay? I'll give you the content, and you guys give me the framework, if you wish, okay? So we'll work on that way. So next week, next Sunday, is it next Sunday? Let me double check the calendar, because next week is gonna be a little different on my side. So let me make sure I'm saying this correctly, because I know, for example, that we will not have Tuesday this week. Exactly. So this week is going to be Thursday and Friday and then Sunday. Okay, so we do have Sunday next Sunday. Okay, good, perfect. Yeah, what changes is that normally we do Tuesday and Thursday, and this week, as an exception, we will not do Tuesday and Thursday. We'll do Thursday and Friday, but that's for trading. Okay, trading for short term and trading for longer term. So hey, on Thursday I'll be applying some of the things that we learned today, and then on Sunday we'll keep going with more sharpening and more rules and more of the why the rules are the way they are and more of the details of the rules. Okay, guys? So, hey, see you on Thursday, my friends. A super pleasure to spend these 2 hours with you guys. And you guys deserve to enjoy the remaining part of Sunday, guys. This is been intense 2 hours. So good job keeping up with the pace and the content. And see you soon, my friend. A pleasure, real pleasure, guys. Take care. See you next week. See you on Thursday on the get together, guys. Bye-bye. Take care. By the way, if you haven't yet, click on the subscribe button for your YouTube channel. Okay, guys? And also click on the bell. We're getting organized for sessions to come. I said that before, but just in case you were not in those sessions, we'll be adding, special sessions, premium sessions, series of things. And we'll be notifying automatically via YouTube. So I need everybody to be subscribed and click on the bell so you get real-time notifications, okay? Cool. Everybody takes care. See you soon. Bye-bye.